speaking now with Spencer Cole. He is a Chief Investment Officer at Vox Royalty, a royalty company. We'll be talking about Vox's projects and the outlook for the commodities markets at large. Welcome to the show, Spencer. It's good to have you here.
Pleasure to be here, David. Thanks for having me.
Vox Royalty, VOX on the Venture Exchange, VOXCF on the OTC. Tell us about your company and the projects that you have.
Absolutely, David. So Vox is a really unique mining royalty investment company. We've been around for the better part of the last 10 years, but we've only been public for the last 2. So still a relatively new name in capital markets. Our business model is focused on acquiring existing royalties, typically from prospectors or individuals that discovered the deposit, and we acquire those royalties directly from them. So we're not funding mining companies per se. We're going out into the bush and finding forgotten royalties and acquiring them at quite compelling value for our shareholders. Okay. The key part of our business, David, that gives us a competitive edge is over the last 10 years, we've built the world's largest proprietary royalty database that has over 8,000 royalties. So we use that information advantage to find forgotten royalties.
Okay. Describe the differences between royalties versus streams, because there's a little bit of a difference there. Both kind of the viewers should understand that in both models, you pay an upfront fee or provide capital to a project, and in return, you get some sort of revenue or revenue sharing, depending on your contract and your agreement with that project. But you're a royalty company, not a streamer. Explain the differences.
Yeah, it's a good question, and investors ask us this quite often. So I guess the simple way to think about it is a royalty is typically a percentage of top-line revenue. And often they're created when a prospector discovers a mineral deposit but doesn't have $200 million in their back pocket to build the mine. So they'll sell the mining claims to a developer, and they'll keep a certain percentage of revenue in a contract. A metal stream is quite different. Generally, you pay an upfront amount to buy a metal stream, and then you pay an ongoing operating cost. Let's say you pay $50 million to acquire the stream, and then you pay maybe 20% of the spot metal price to acquire those units of metal. The difference with a royalty is you just pay an upfront cost to acquire the royalty and then no ongoing operating cost. So we much prefer the royalty model because once you've made that initial investment, we don't have to invest any additional capital prior to getting that revenue.
It sounds just like private equity. Would you characterize your company model as basically just a private equity firm for miners?
Yeah, look, there are similarities between private equity and what we do. I think the fundamental difference is some royalty companies fund mining companies, so they'll buy new royalty contracts. So let's say you're building a mine and you need $100 million. A royalty company will give you $100 million in return for a new royalty. We don't do that business. We don't think the returns are as compelling. We go to the prospector that has an existing royalty and acquire that from them, typically for a more discounted price.
One of the upsides I've heard of investing in a royalty company such as yourself is that you're not really exposed to the operating costs because you've invested in these companies, you've given them capital, but you're not really operating in the field yourself. So we've seen all-in sustaining costs go up. Does that directly affect your bottom line at all?
No, you're absolutely right, David. So one of the key benefits of owning a royalty company is there's no capital inflation, no operating cost inflation. So if anything, I think royalty companies typically outperform in periods of high inflation because as the commodity prices go up, the 1% of revenue or 2% of revenue in our royalty contract means that we're getting a larger slice of revenue going forward. But our operating costs are just a few people sitting in an office. So we're not exposed to any of that cost inflation.
Sure. And now, Spencer, some investor might say to you, well, look, Spencer, that sounds great, but how do I know that some of the companies in your portfolio won't go bankrupt or won't default on, let's say, their obligations, or let's say their project, it won't be successful? How do you mitigate those risks?
So the key way we mitigate that risk, David, is we've got 60 separate royalty investments. So even if, God forbid, one of them had operational issues or any other related issues, we've got 59 other royalty investments that we're diversified across. The other aspect I would say is, we do very rigorous due diligence when we make our investments. Our management team is a team of mining engineers and geologists. So we ensure that we are, buying a truly valid and enforceable royalty contract so that there's no risk that the mining company can, exclude their obligation.
Do you provide consulting services as well? Is that part of your contract?
No. I mean, we as management, we own 15% of the company. So we wear one hat and one hat only, which is the Vox hat. Right. And so our sole focus is on acquiring royalties at really great value and then growing shareholder value across our portfolio of royalties. So we don't do any third-party consulting.
Okay. And tell us about the breakdown of your portfolio. How much gold, how much in base metals?
Absolutely. So of our 60 investments, about 70 to 75% of them are in precious metals. And the dominant metal within that basket of 75% is gold. We do have some silver and PGM exposure as well, but that 75% is heavily weighted towards gold. Yeah. The other 30 to 25% of our portfolio is across base metals such as copper, nickel, zinc. And then we also have some battery metals such as vanadium, and we also have some iron ore exposure as well. Okay. So we are precious metals weighted and dominant, and we will be that way forever.
All right. Now I'm going to come back to your outlook on the metals in just a bit, but an investor might also ask you, Spencer, I know your portfolio of projects that you've got here. Why can't I just invest in those companies myself? What's the benefit, added value of having a royalty company and investing in a royalty company that has a portfolio of these assets?
Yeah, this is a great question, David, and we get that from a lot of generalist investors. They say, shouldn't I just buy the operator? Now, the key benefit to buying a royalty company such as Vox is, compared to the operator, is firstly, you don't have that single asset exposure or risk. So if that single asset of that operating mining company goes out of business, God forbid if the government nationalizes the asset, you lose that investment, obviously. So we offer that portfolio risk diversification, having 60 separate investments. The other key benefit in owning a royalty stock such as Vox is you don't get any of the dilution that you typically get from a mining operator. So we took one back-tested example. There's a gold mine in Ghana that Perseus operates called Edikan. Over the last 10 years, that mine has mined about 2 million ounces of gold. But the operator, in developing that mine and operating it, they've diluted their share count by about 60%. Right. During that same period, Franco-Nevada held a 1.5% revenue royalty, and they've got full payback on their investment, and there's still 6 to 10 years of mine life left on that investment. Yeah. So you get none of that dilution that mining operators typically experience. Right. When you invest in a royalty company such as Vox. So
I guess one of the main benefits is for people who can't have the capital or don't have the capital to invest in 60 or 70 portfolio companies themselves. Spencer, tell me more about this model. Do you own equity in some of these portfolio managers, or you just provide them capital?
No. So we just we own a contract that entitles us typically to a percentage of top line revenue from the mine. Yeah. So we have no equity exposure to the mining company.
So if one of these companies get bought out or something, you don't get the upside?
No, to the contrary, David. We get the upside when that project gets bought out and it's part of a larger company with a larger capital base. Our royalty is almost like a mortgage where the royalty runs with the land. So the royalty contract stays with that mine into perpetuity. So if a bigger company comes along and buys that project, that's fantastic news for us.
What's the average mine life of your portfolio, you think?
Our average mine life is between sort of 10 to 16 years currently. We have some assets that are closer to 40 years, but that's on a weighted average basis. That's about our mine life.
Okay, and approximately how much mine life have you got on average left?
So that is the remaining mine life.
That is the remaining.
Okay. 12 to 16 odd years.
Okay. Well, let's talk about expansion and your next steps. You got 60 odd companies. Are you acquiring more? You got more things in the pipeline? What's going on?
We've got a lot up our sleeves, David. A lot of new exciting deals. So last week we announced the acquisition of 3 new gold royalties in Canada. Yeah. 2 in Ontario, one in Quebec. Right. The week before that, we announced the acquisition of a large iron ore royalty in Western Australia. So this year alone, we've acquired about 7 new royalties. In the last 3 years, we've acquired 50 royalties. So we would expect to announce a few new accretive acquisitions over the remainder of this year as well.
Okay. Let's go back to the metals. So you've got a breakdown of base metals and precious metals. Now your share price has been down from the beginning of the year to date, like most junior miners have been. would you say that's mostly because of the metals going down, the metals that you've been exposed to, or a broad market sell-off that we've seen across equities?
I'd say I'd hazard a guess, it's more because of the latter. So in 2021, we were actually the top performing royalty stock in the entire industry.
Yeah.
So we led the industry from a share price appreciation perspective. This year, obviously we find ourselves in a risk-off market, uncertain as to how equity markets will perform. The most important thing for us as a company is that, we've got a number of new royalties that are just moving into production. So even if we made no future acquisitions for the next couple of years, we're expected to go from 6 producing royalty properties this year or currently to 11 plus by the end of next year. Right. So even if we do nothing, even if there's contraction in the metal prices, our revenue will continue to grow just by virtue of all the new royalties that are starting to produce in our portfolio.
Okay, and which of these metals do you think have the most potential for investments upside?
We get this question often, David, and the unfortunate reality is we don't have a crystal ball that tells us, no, of course nobody does. But what I would say is, we're heavily weighted to gold. And importantly, we're heavily weighted towards gold production in Western Australia. Okay. And if you look at the gold price in Australian dollar terms, for the last 4 years, it's been at pretty much record levels. So even at $1,850 an ounce, in Australian dollars, it's closer to $2,600 an ounce. Right. So if you're producing gold in Western Australia right now, you are printing cash. And having 35 predominantly gold royalties in Australia, as we do, we are hugely exposed to that extremely, near record gold prices in Australian dollar terms. So even if the gold price was to contract by 20%, which we don't necessarily think that's going to happen in the next 12 months, but even if it did, we're still coming off record Aussie dollar gold prices.
So you're exposed to the companies in terms of gathering their top line, the percentage of the top line. Now, Spencer, do you think rising costs, rising inflation across the world have impacted the miners insofar as they have to cut back on their production, which may hurt your top line?
Yeah, it's an interesting question. We haven't seen it impact producers as much, but certainly developers and those that are building projects. We've seen, I guess, people pivoting towards, more M&A or, consolidating existing processing plants, for example. Like one of our royalties is over part of Karora Resources' Higginsville gold mine, and they recently announced a deal where they acquired the Lakewood processing mill. So, we're seeing that more and more is, a willingness to acquire existing infrastructure rather than building greenfields infrastructure. So we would expect that trend will continue. But for us, a number of our key assets are already well into construction. So we're less exposed to that than a lot of others.
Okay. Final question. A lot of people might be wondering how a professional royalty company and investor such as yourself would pick these companies, because a lot of your some of your ethos or philosophy may translate to just retail investing as well. So somebody presents to you, Spencer, somebody presents to you a project, a developer, or maybe even a producer already. They give you the 10K or the audited statements. First 3 things you're looking at.
Well, it's not necessarily in the 10K, but it starts with what's in the ground. Okay. How real is the metal in the ground? Can this actually be economically extracted? Right. Is this excessively deep? Is it close to surface? How much technical risk is there? Yeah. And let's be honest, there's a lot of questionable technical reports out there. So yes. It always pays to have a few people in the know that can tell you whether that's real metal that could be economic in the ground. Yeah. So that's the first thing. The second thing is, what is the operator or the management team's core expertise? Are these explorers that are, successful with the drill bit? Are these mine builders, or are these operators that can sweat the asset? Truly understanding, what this management team is good at is absolutely critical, because there's a lot of management teams that claim to be one thing, but have they actually delivered that in the past is a separate question. And then the third point that we look for would be access to capital, particularly in these markets that are, quite constrained. Can this company actually fund either, the development or expansion of this operation? And, when capital is tight, as it is currently, not everyone can find that capital. So,
which is where they turn to you.
They would turn to other royalty companies that write new royalties. We would stick with existing royalties. So because we don't fund mines ourselves, we're typically funding the retirement of a prospector that holds an existing royalty.
Oh, is that
but
right?
certainly they could turn to our friends at Franco-Nevada or Wheaton.
You wouldn't fund an entirely new project.
No.
Is that too much risk for you? What's the rationale there?
What we see typically, David, is if you're writing new royalties, you're competing with conventional debt and equity providers.
Okay.
So the returns you get on new royalties are typically much lower than if you're finding existing royalties and acquiring those. We typically target.
Are you really competing with debt providers right now? I mean, are banks really going to finance a junior or a new project right now at this time?
Well, I mean, look, if you're funding a mining company or a new mine, like you're competing against all other sources of capital.
Sure.
Whereas if you're finding a forgotten royalty out in the bush or in the tundra, you might be the only group that they're speaking with. So, you're taking on some risk, but the returns you can get from existing or secondary royalties, historically over the last 20 years, have been significantly higher than new royalties.
What about? Last question. What about sources of capital for yourself? If you were to expand, would you be looking at more debt or equity right now?
Look, we are deeply undervalued relative to our peers. Okay. Everyone tells you at PDAC that they're deeply undervalued, but when you look at the relative valuation metrics of our peer set, we're trading at between half to a third of where our royalty peers trade. So we have no intention of raising equity at these prices, particularly because we own 15% of the company as management. So I'd say that the way that we'll continue to finance our growth will be debt. We're speaking to a few debt providers at the moment. And then selectively, some prospectors actively ask for our equity. So selectively, where we find really great royalty acquisitions, we may issue some of our stock with a long-term lockup to ensure that stock doesn't hit the market anytime soon.
All right, Spencer, excellent thoughts. Thank you for sharing your company story with us. I appreciate it.
Thanks so much, David. Pleasure to be here.